Hey traders and investors, this is going to be a video talking about how to build a recession-proof portfolio in the year 2023. By the end of this video, you should be confident in your investments despite the bearishness that we've seen in the overall market in the past 12 months during the year 2022. So make sure to stay through this entire video to get all of my tips to help yourself build a recession-proof portfolio. Now, tip number one is going to be to sell out of the underperforming stocks that you have in your current investment portfolio. If we take a look here at the chart for SPY, which is the ETF for the S&P 500, this can be a good gauge of how the overall market performed over a certain period of time. And we can see that looking at this year to date, the S&P 500 has fallen a little bit over 20% from its high back in January of $479.98. down to its current price of $375.70. So technically speaking, any stock that is down more than 20% for the year would be considered an underperforming stock. These stocks do, of course, have the potential to bounce back once the overall market starts to recover. However, they are going to have a more difficult time getting back to their highs, even as the overall market starts to make new highs itself. So odds are, if you've been investing in the year 2022, you're probably holding on to some stocks that you probably should have sold a few months back that are currently underperforming the market. A few examples of this might be PayPal, for example. PayPal, we could see back in January, was up at $196 per share. It's currently trading at just about $67 per share. Another example would be Meta. Meta underperformed the market severely in the year 2022. Falling from the high in January of $343 all the way down to its current price of about $115. So obviously down well over 50% for the year. Another example might be Netflix. Netflix was up at $609 per share in January, currently trading at over 50% below that price at $293 per share. So again, these stocks, of course, can bounce back in the future, but all I'm saying is that odds are in your current portfolio, you most likely have some underperforming stocks that you most likely should have sold a while back, but it's better late than never, and now is going to be a good time to rip that band-aid off and sell out of those underperforming stocks. Now, what this is going to do by selling out of these underperforming stocks is it's going to free up some of your investment capital and give you the opportunity to start building yourself a recession-proof portfolio. Okay, and that's going to lead us, of course, to the next step, which is going to be to diversify. Diversification is very important for any type of investment portfolio, especially one that you plan on being quote-unquote recession-proof, which is going to be a portfolio that should outperform the market, even when the overall market is bearish, like we've seen it over the past 12 months. Now, diversification in its simplest form is splitting up your money into different investments. So instead of being 100% in a stock like Apple, for example, you could put 50% of your portfolio in Apple and then another 50% of your portfolio in something like Microsoft. Microsoft and Apple, of course, are two different companies. They have different earnings, they have different financials, they have different market caps, so they are, of course, going to trade a little bit differently than each other. But what I really want to emphasize is that it is important not only to invest into different stocks, but to make sure that those stocks are actually going to be in different sectors of the market. Apple and Microsoft may be different stocks, but it actually would not be a great idea for you to put 50% of your portfolio into Apple and the other 50% into Microsoft, because that's not going to be a very diversified portfolio, since Microsoft and Apple both are in the technology sector of the market. Generally speaking, the largest stocks in different sectors of the market are going to be moving kind of hand in hand. So Apple and Microsoft are going to have very similar charts because they are two well-known technology stocks. So again, you're not going to be getting much diversification by splitting up your investment into those two stocks alone. If we take a quick look here at this heat map of the market, we could see different sectors that are actually going to make up the overall market itself. We have, of course, the technology sector, we have financial, we have healthcare, we have communication services, consumer cyclical, industrials, real estate, energy, consumer defensive, utilities, basic materials, and so on and so forth. And of course, there are different smaller industries within each of those sectors, but splitting up your investments into these different sectors themselves is going to be a good way to get started with a diversified portfolio. Now, the next thing that's going to be important when it comes to building a recession-proof portfolio is going to be to actually make sure that some of your portfolio is diversified into sectors of the market that tend to outperform during an economic recession. And the way that you can come up with these different sectors is to kind of just think about what we need on a day-to-day basis, even as the economy is in a recession. If you think about it, something like Apple, for example, even though everybody wants the new iPhone, everybody wants the new iPad and MacBook, if the economy is in a recession and the general public has less money to spend, these Apple products are not necessarily going to be a necessity. They're going to be more of a luxury, and people are going to be less inclined to buy the new iPhone, buy the new MacBook, and so on and so forth. On the other hand, even in a recession, people are still going to need healthcare. People are still going to be using gas to get to and from work. People are still going to need to go and buy groceries. So sectors that tend to outperform in a recession would of course be healthcare, energy, and consumer defensive. So I believe that dedicating a portion of your investment portfolio to these three sectors is a good way to make sure that you're positioned well for your portfolio to handle a recession. Now, the next step to build a recession-proof portfolio is to hedge your investments. One of the best ways to hedge a portfolio is to simply buy long-term put options. Over the past year, again, we've seen the S&P 500 fall a little bit over 20%. Anybody that had hedges in place back in January by having some long-term put options in their portfolio would have easily been able to offset a good portion of that loss by having those hedges in place. If we take a look here at the profitability chart of a put option for SPY, what we could do is go to the options profit calculator here, and we can go ahead and select a long-term put option. Let's go ahead and look about a year in the future, and we'll go right at the money for this strike price. And by clicking on calculate and taking a look at the profitability chart down here, we could see that if we were to have these long-term put options in our portfolio, and then the S&P 500 falls about 8% down to 343, we would be able to make a 20, 30, even 40% or more return on that hedge investment simply by having some of these put options in our portfolio. Now, I will say that you don't want to go overboard with a hedge investment, because if we take a look at the longer term time frame here for the SPY chart, we can see that the price action that we've seen over the past year is not typical. And if the market is going to be bullish, it can be bullish for a very extended period of time. So when the market is bullish and it is trending higher and higher and higher, these put options most likely are going to expire worthless. And if you weren't managing your risk for those put options, you would most likely lose 100% of what you invested into them. So that's why having hedges in your portfolio can be thought of as a little bit controversial. But if the market is bearish and it is trending lower and lower for weeks or months at a time, it is a good idea, in my opinion, to have a small portion of your portfolio dedicated to having some hedges in place. The next step that I want to talk about is to use a small portion of your portfolio and dedicate that portion to doing income-producing option strategies. A really solid example of this that I believe everybody should be doing right now, especially as the market is in a downtrend, is the covered call strategy. If we take a look here at SPY, let's look at the 1 day, 1 year chart, and I'm going to go ahead and draw a line here representing our investment into SPY. So if this line is the price that we decided to buy into SPY back in June, for example, we could see that right now we would be pretty much at break even on this investment. SPY might have bounced all the way up to about $432 per share after we got into this investment, but if you didn't sell and lock in those profits because you decided to be in this longer term, you would be back to break even on this investment. But if you were using the covered call strategy during that time frame, you would be able to, on a weekly or monthly basis, depending on your preference, bring in a steady stream of income by selling covered calls against your investment in SPY. Now, the way that covered calls work is, if we take a look here at the options profit calculator once again, we can go ahead and put in our investment here for SPY. And let's just say that we are in 500 shares. Obviously, this would be a very costly investment, but I'm just using it for an example. You could do this, of course, with lower price stocks as well, as long as they have an options chain and you're able to sell your covered calls. Okay, now because one options contract represents 100 shares of the underlying stock, if you have 500 shares, you would be able to sell, or in other words, write 5 covered calls for this investment. So the idea behind covered calls is simply to look either a week or a month generally in the future and sell a call that is out of the money and is at a strike price that you do not believe the price of SPY is going to reach. So let's go ahead and look about a month in the future here. We'll select January 20th, 2023, and let's just go up to the $410 strike price because $410 was a key resistance level that we've seen over the past few months here in SPY. So you can see that we would be getting 53 cents in premium per contract for these covered calls, which would give us a total of $265 in premium. Now, the way that this process works is as long as the price of SPY remains below $410 per share by the expiration date, which is about a month away, we would make this entire $265 profit. Essentially, the worst case scenario would be is if the price of the stock closed above $410 per share on the expiration date. In that case, what would happen would be our options would be exercised, and as the option seller, we would be required to sell all of our 500 shares at the predetermined strike price of $410 per share. So we would still be selling at a significant profit, seeing as how our investment in this example is at about $374 per share. But the only downside is that if the price within the next month were to shoot all the way up to $440 per share, we would be missing out on about $30 per share in profit on our investment because we would be required to sell at the strike price that we selected at $410 per share. That's why you want to make sure you select a strike price for your covered calls that you believe the price is going to remain below. So that way, all that you have to do is sit back and let the price action work in your favor so you can collect the entire $265 in premium. Doing this strategy for all of the investments in your portfolio can be a really great way to earn some extra income on a weekly or monthly basis, depending on if you're choosing options that expire a week away or a month away. And it's kind of a very similar process to collecting income the same way that people investing into dividend stocks would. There are actually multiple other different income producing options trading strategies that you can use. There are cash secured puts as well as iron condors. Both of these can consistently produce income in any type of market condition. So if you want to learn more about these different strategies, make sure to comment below and let me know, because I would be happy to make more detailed videos about them in the future. Okay, now with all of that being said, there's one last tool that I want to talk about that is 100% free, and that can be a really great resource to show you how you can build a recession-proof portfolio. This is going to be over on portfoliovisualizer.com, and what we're going to do is we're going to scroll down to portfolio optimization. And what I want you to do is, after you've come up with a potential investment portfolio using some of the guidelines that we've talked about in this video, splitting up, of course, into different sectors and making sure that some of your portfolio is invested in sectors that perform well, specifically in a recession, then what you can do is you can put in that information here into the portfolio optimization. Let's go ahead and put SPY, for example. We'll put NVIDIA. We'll put some into, let's do an energy stock like CVX. We'll put some into Bank of America for financials. And then let's put some into consumer defensive, so we'll go with Target. And if we just equally split this up, 20% allocation into each of these investments, and then we go ahead and click on Optimize. Down here, what this is going to show us is the portfolio that we provided here, of course 20% into each of these 5 investments. And then it's going to show us the recommended portfolio based on the maximum Sharpe ratio. Now, by definition, what a Sharpe ratio is a measure of performance of an investment such as a security or a portfolio compared to a risk-free asset after adjusting it for risk. I know that sounds a bit confusing, but simply put, a maximum Sharpe ratio is going to give us the best return for our investment with the least potential amount of risk. And in order to achieve that, using, of course, the past performance of these stocks, the portfolio optimization tool here is recommending that we be invested about 45% into CVX, 33% into NVIDIA, 23% into Target, and it's essentially recommending that we cut Bank of America and SPY completely out of our investment portfolio. By doing this, you can also compare then the performance of the portfolio that you provided and the portfolio that they provide us with the maximum Sharpe ratio. Both of them start with a balance of $10,000. Our provided portfolio at the end would be $261,000 with a maximum drawdown of 63%. That means that this portfolio at some point had fallen about 63% from the highest point that it had previously been. On the other hand, the portfolio that they show us goes from $10,000 to $602,000 and only has a maximum drawdown of 54%. Now, there are a lot of different optimization goals that you can set in here to give you different potential portfolios. By default, it's going to be the maximum Sharpe ratio, but if you wanted to, for example, look for the maximum potential return, and you don't necessarily care about how much volatility that portfolio is going to face and how much it's going to draw down, you can click on Optimize, and you can see that historically speaking, the best potential investment here with the stocks that you provided in your potential portfolio would be to simply invest 100% into NVIDIA. That would have turned your $10,000 investment into $1.8 million. And with great potential return, of course, comes great potential risk. So you can see that it does have a very large drawdown of 87% from its high. Okay, now that might not be very recession-proof itself, but this can be a really great tool to help you optimize your portfolio a little bit better to see which stocks maybe you should be invested in a little bit more heavily and which stocks should be a smaller part of your diversified portfolio. But that's going to be a wrap for this video here, building a recession-proof portfolio in the year 2023. I hope you found some value, and if you did, please make sure to give the video a like and subscribe to the channel. And if you want to learn more about day trading, swing trading, and long-term investing, and join us in our daily interactive trading group, you can find more information on that at my website, Master the Market, which will be linked down below in the description. But anyway, thank you again for watching. I hope you enjoyed, and good luck with your trading and your investing.